And we are.
Hi, everybody. This is Josh Mansky with Corn Belt Newsletter Podcast. I am super excited today to have Dr. Rabil from Iowa State University, who just completed the land survey, all the data points that we think we know, but we need some hard data. She is going to provide us with a little presentation today and then follow up with some questions by yours truly. So, Dr. Rabil, why don't you get us started and show us kind of what you found for the year 2025?
Thank you for having me. It's always a pleasure to talk about the land value survey and to do it right after it's done. It's like when everything is still very, very relevant. I'm glad you're giving us this opportunity to talk about things in more specific details than I generally do in the press conference. So thank you for having me. I will begin with sharing my slides right here. And we'll talk about a lot of things related to the land markets. And I'll also end at the end a little bit with some data, some information about corporate or foreign investment presence, since that's a question that has come up often enough that I think it now deserves dedicated slides. So if you have any questions along the way, Josh, please go ahead and share those. And with that, let's begin. Oh, and I will begin with this reminder that we have everything that I will discuss today and everything else related to farmland on our farmland portal, which is farmland.card.iastate.edu. You can find the latest survey, visual tools graphing that survey, graphs to see the trends over time. We also launched a visualization mapping tool for the foreign investment data, the AFIDA data on the portal last year, and another tool to see the consolidation in farmland sector, the ag consolidation tool, another mapping tool to sort of see both the data, the trends, how they have changed, and you can find both of those on our portal. So with that, let me get into the farmland markets. So we care about the farmland markets because that's generally the biggest item on most people's balance sheets. Anybody who's associated with agriculture, that's the biggest ticket item that they're going to purchase generally in their lives, or they're going to own or invest in it. And we like to keep an eye on its value because it generally is a simple and straightforward way to check the health of the farm sector. Farmland values going up indicate a strong ag sector, indicate strong incomes. Values going down tell that something is not really perfect in the farmland sector or the agricultural sector. And we'll discuss today the overall trends in values and some of the reasons that are contributing to those trends that we are seeing. So before that, if we're looking at the entire country, we are the owners, proud owners and residents on some of the most expensive real estate in the country. Iowa farmland real estate values, according to the USDA data, are at $97.90 per acre, which is second only to California. And they are also up around 4% from last year. And if they specifically go only to cropland, then the cropland values are around $10,300 per acre. So the USDA farm real estate includes a lot of hobby farms, individual small operations that we don't really consider big farm businesses. You can multiply this value anywhere by about 1.3 to 1.5% or times to sort of think about the Iowa real estate. And that's what we see in our survey as well. So looking at the Iowa specific numbers, at the end of 2025, the farmland values in our state stand at $11,549 per acre, which is an increase of $83 or 0.7% compared to last year. Now, it's a small adjustment, it's a minor change compared to last year, but it's still in the positive direction. And I will talk a lot more about how to think of this change as we move forward. Before we do that, let's put this in perspective of the overall change over the last few years, and then since we started collecting this data at Iowa State in 1941. So first thing, we are at quite a high peak. despite this 0.7 change being small, we're looking at the top right corner of the chart. We are right here. It's much higher than anything we've seen ever before, slightly lower than the record high values we achieved or we reached in 2023. So it's slightly lower than this 20 to 23 peak, but still at a very, very high level. Now, once we adjust for inflation, this is no longer an increase. Then the state level values stand at $8,475 per acre, which is almost a 2% decline compared to last year. In the inflation adjusted values, we have been declining since the last couple of years. The last peak we reached was 2023. And now if we look at the year over year change, this is our small increase compared to a very relatively small decline last year and a few big increases we saw before. Now, I want to talk about this last 3 years and sort of label them an adjustment in the farmland market. We started on an upward trajectory at the start of the pandemic, driven by record high commodity prices, record high government payments, and we saw these peaks in the farmland markets, these increases of about 27%, 17%, leading us to these records that we made in 2022, then 2023. Now we are coming back down a little bit or staying almost there. And this period should be labeled pretty much an adjustment in the market. Now, looking at this overall year over year change, these are no big numbers, but that's where this graph comes in perspective. We are still at a very high level. We're going up a little, going down a little. It's still a very, very high level compared to our recent history. It's by no means a bad place for farmland markets to be in, which also sort of indicates it's these few years do not seem great in comparison to the great markets or great situations we had during the pandemic. But since ag is as usual cyclical, we always go through a downturn after very high peaks. So we are going through that adjustment in a downturn, but it's pretty much expected and it's not really a bad situation in a long run or in a long enough period. Now, let's think about where these changes are coming from. Why is there the 0.7% increase? Why was there a decline last year? So on and so forth. When we think about how land values are determined, they are simply the discounted sum of the income that will be made from farmland. So it can be thought of in this fraction. Localized net income, the income that I can make on this specific farm, divided by universal interest rate, where macro factors tell me how the value of my money is changing over time. What are some of the expenses that will affect everybody equally? Inflation rising will affect everybody equally. It will increase input prices proportionately for everybody. It will increase cost of borrowing proportionately for everybody. So we have this localized next to the net income and a universal next to the interest rate to indicate that the value of my farm depends on the income I can generate from it. And then it's discounted by the interest rate that comes more from the macro factors that affect everybody more or less equally. Now we looked at the Iowa Farmland Value Survey. We also like to put that in perspective of what others are finding. The respondents for some surveys may be a little bit different than others. So this is the Ag Letter Survey or Ag Letter newsletter that comes out of Federal Reserve Bank of Chicago. And in their survey, they found that the farmland values for Iowa in the last or the third quarter of last year declined or stayed pretty much zero. And if they consider an overall annual change, Iowa land values declined only a little bit. So I will say any change between -5 to +5% is pretty much stability in the market. It's not a big difference, but overall, it's still it's quite close to the 0.7 increase we're finding. One difference that occurs between our survey and this is that the Federal Reserve Bank of Chicago surveys lenders and bankers. which is a big portion of the respondents of our surveys. But our survey also goes out to appraisers, farm managers, real estate brokers, landowners, and as well as government officials, uh, assessors, etc. So their survey found this for Iowa. And then if we look at some of our neighbors, Wisconsin reported an increase in land values, Illinois an increase in land values, Indiana an increase in land values over the pretty much most of 2025 year. Why is that so? Why is it that our neighbors seem to be sort of doing better, but even if we consider the Iowa state increase of 0.7%, it's still sort of smaller than what our neighbors are reporting. One more thing that this survey specifically highlighted was the dichotomy between the crop farmers and dairy farmers. That's an emerging theme that has been mentioned here and there in a few other surveys in individual experiences over 2025, starting from the end of 2024. But it's right now that it has become quite clear, and that divide between the two sectors is what's really new in the markets this year, or like that. It has become crystal clear in the markets this year. According to their survey, the crop farmers expect their cash earnings, their income to be lower than they were a year ago. And dairy farmers, a much smaller number of dairy farmers expect lower earnings. They may not expect increases, but they still expect more of a stability in the market than the crop farmers. Cattle and hog farmers expecting much higher net cash earnings, and it's those animal sectors that are keeping the markets up in certain areas, certain regions, and in some cases in some states. Now that explains Wisconsin a lot better. Illinois and Indiana also has something else going on. While they do not have animal operations across the state the way Wisconsin does, in some senses, the farming operations are more similar to Iowa. What's different in these markets, in these two markets, is that they are open markets. They are open to institutional investors. They're open to other sectors. These are not farm-only markets or farmer-only markets. Iowa is a farmer-only market. And that's another reason for a little bit more stability in these two markets. There's some research work that's currently underway that I'm doing with some colleagues in Purdue, and also some colleagues from the company Acres. So what we recently found, or what we're seeing, is that it seems to be that some of these other markets in Illinois, Indiana, sometimes become more stable due to the investor activity. Because if the ag sector is not doing so well, this is not necessarily the time a lot of farmers will make big capital purchases. This is not the time that they will really go and invest in farmland or buy land, unless it's that one farm that they really, really, had an eye on and it's become available. It's not going to be a general sentiment in the market right now for farmers. But when it comes to institutional investors, what some colleagues have also highlighted to me at other times is that they are generally interested in a turnover of 3 to 5% over a time period of less than 5 years or around 5 years. So any time is a great time to buy, as long as you know that farm, you evaluate that farm, and then you know that within a 5 year span you're going to be able to sell it again for a higher price. Especially when ag markets are not doing so well, we know that since a downturn is coming, it eventually there is going to be a peak as well. And when that peak comes, we will see that those profits, those benefits in the ag sector translate over to the land markets as usual, as they always do. So maybe from that sense, it's a good time to buy for investors if they want to turn it over within 5 years, within 7 years. So those sort of motivations also keep the markets more stable, even when the ag sector doesn't seem to be doing so well. So that's what keeps these two states, in my opinion, a little bit more stable generally. Even when Iowa had very high values, very strong increases, these markets were more stable. Because again, when farmland is at $25,000 an acre, $30,000 an acre, that number doesn't make sense for an investor. They're never going to buy at those prices. So when we were experiencing those runs, the neighborhood, our neighbors were still at 10%, 12% increases or changes, and we were at 27% increase statewide. So they have generally absorbed both the highs and the lows. The investors, since their motivations are separated from the crop operations or the farm operations, they keep the markets more stable by that sort of keeping their expectations only within a specific range that is neither too high nor too low.
Dr. Robel, does that have to do with Iowa's anti-corporate farming laws? Is that what's keeping those institutional investors out of Iowa and going to
Yes.
Illinois, Indiana?
Yes, yes. Iowa has very strong, very strict anti-corporate farming laws, which Illinois and Indiana do not. Wisconsin also has some restrictions. Minnesota also has some restrictions. Illinois is a pretty much open market. Indiana is pretty much open market. So when you think of retirement funds, when you think of what TIAA is investing my retirement money in, they're going to buy that farmland in Illinois. They're not really going to buy that in Iowa because they cannot legally. So there are those big institutional investors that have farmland as part of their portfolios. There may be other smaller corporations, not as big as TIAA, which are still institutional investors by definition and by operation. So like those entities are present in our neighboring states and not in Iowa. So another survey that I like to refer to is the Ag Credit Survey that comes out of Federal Reserve Bank of Kansas City. Their recent survey also showed a divide between ranch land values and the irrigated or non-irrigated cropland values. So the ranch land values are relatively higher. They have not fallen as much over the last couple of years, whereas the cropland values fell, even though they are the numbers are better than they were in the last couple of periods. For irrigated cropland, the change is still less than zero. The farmland values actually fell. So, and they rose for ranch land. And we see the sort of relationship when it comes to cash rents as well. The income that land is making for ranch land is in the positive, it's rising, but for croplands, it's falling. And that divide is what we saw implied in the Federal Reserve Bank survey. But here, since they actually separate the two measures for ranchland and cropland, we are able to see it more clearly. And they also ask their respondents about some reasons, and they highlighted specifically in their survey that crop dependent regions are facing more challenges in terms of incomes. That's why their values are weaker, whereas the cattle dependent regions are seeing higher incomes, which is supporting the values in those regions. Now, when we look at farmland values percentage change compared to last year across Iowa, we can sort of map it that way. A couple of things I'll highlight before we get into that. The county with the highest farmland values this year was O'Brien, same as last year, at $16,269 per acre. The county with the lowest value, so right here, this was the highest value last year. And then Athens County right here was the lowest value last year, similar as this year. So our overall rank does not really change, even though we see percentage increases in some areas, decreases in some areas. The overall rank of what are the most expensive farm grounds in Iowa is pretty much consistent with minor switches in ranks across the state. Now coming back to the geographical trend. So what are the areas we think as the primary regions for animal operations? Those are the regions that have these corners of the state right here, the east central part right here. These are generally more animal operation oriented areas in the state compared to the rest. And that is where we see the income, the land values actually showing increases rather than declines. The areas that are more traditional crop only regions, sort of show some negatives. Of course, there is a lot of diversity within farm as well, within county as well. But broadly, this is what we're seeing. And now when we this is a chart I downloaded from the Iowa Farm Bureau, and they were measuring the animal units in Iowa in 2022, and this is what we see: the areas, the corners of the state, some central part, but much more the corners of the state. The east central part is where we see higher number of animal operations, and that is some of the areas where we saw stronger land values or increasing land values within Iowa as well. If we look at the incomes that were the income projections or the income forecasts for these two sectors separately, we can see the same thing again. We can map it more clearly. If we're looking at the crop sector, all the crop sector, the only exception being the fruits and tree nuts right here, all other crops, the 2024 numbers are higher than 25. We are declining. Our cash receipts, our incomes are declining. So we mostly, in Iowa, we care mostly about the top two. So over there as well, we see that. When we go over to the cash receipts for the animal products, we see the only decline is reported for dairy products, which is a much smaller decline than we're seeing here, and relative to the increases we are seeing in cattle, broilers, hogs, this small decline in milk is not as substantial. So the cash receipts for the animal sector are much stronger than they are for the crop sector, which is explaining the divide we are seeing in the markets right now. This is the same information, but now we have combined the crop receipts and the animal receipts and overall all commodities. So even though the net farm income or the cash receipts seem to be high, seem to be going up, there is a divide between the two sectors. So overall land values sort of show this trend. Overall, there's a small increase, but when we dive down deeper, we see that it's coming from some declines experienced by areas that are more crop dependent, some increases experienced by areas that are more livestock dependent or animal dependent, based on the incomes or the cash trends, cash receipts in these two sectors. Yeah, one more thing I'll highlight is that even though it's a tough time, if we narrow down only on the time period right before pandemic till now, overall the cash receipts for the animal sector are much higher. For the crop sector as well, we are pretty much similar to that, on par with that. So to me, the bigger problem is not the income, it's more so the profits and more so the costs. So our incomes, our crop prices are not terrible right now. They're lower. We all want them to be higher. That's true. But the bigger problem is not coming just from the prices. It's mostly coming from the costs. So we see this income situation, or the divide between the trends and the receipts, is worsening the situation for crop sector because of the pressure from the cost side. And we'll talk about that a little bit later as well. Yeah, overall, the usual suspects have the highest, strongest farmland values. Scott always is in red, so we have this strong East Central in general as well. And the lowest counties, the lowest land values are always reported in the southern part of the state. And there are no surprises over here. We have the same sort of rank and relationship maintained, despite the fact that the percentage changes were quite divided this year, or quite different than what we're used to seeing in recent years. Some of the factors that influenced farmland markets this year, the biggest positive factor that was reported in 21% of responses was limited land supply. We'll talk about that a little bit later. And then strong yields. Yields have been stronger, especially given the southern rust and where we export the problems we expected. We have landed much better than we thought, or we had. At least I was scared in there for a bit, thinking that it's going to be a very difficult year, but we landed much better than the mini scare we had. Then the next couple of factors, in fact, let's group together the next three factors. It's the cash and credit availability, strong demand from a lot of buyers, and then the investor demand. That has been a defining factor in the land markets over the last 5 or so years. It's likely been there always, but over the last 5 or so years, I'm mentioning specifically since we started getting the pandemic payments and since we had those very high crop prices. What that did was it really built up the cash reserves. And overall, a lot of Iowa farmland, 84% of Iowa farmland is owned debt free. So there's not a lot of leverage, mortgage, anything for farmland for a lot of buyers. So anything else, a lot of these payments, when they build up the cash reserves, it puts those people in a very strong position to buy farmland. And that demand has been very supportive in the markets in 2023, even in 24. In 25, that demand has been selective. There hasn't been as many transactions. The land markets have been slow, but we still saw the $32,000 an acre record in Sioux County. So the buyers, when they are acting, they have that ability, they have that strength. So that still exists. And the last factor we have is livestock gains, and we have talked already. It has become a dominant factor independently, especially because of the divide between the crops and livestock sector. Now, specifically talking about the land supply, there's a lot of information. Sorry about this graph being so busy. Well, let me break it down step by step. So the green and red bars are something we have seen before. This is the year-over-year change in land values. We begin with this. And then I have, on top of this, I have put an index for activity in the land market. This black line is this activity index. And the way this activity index is computed is it's 100 plus the percent of our respondents that reported more sales compared to last year, minus the percent of our respondents that reported less sales compared to last year. What that tells us is if we compare it to 100, which is the benchmark over here, this line being above 100 means more farmland sales were reported compared to last year. If this is below 100, it means less farmland sales were reported compared to a last year. Then, now when I plotted this over, my intention for putting it specifically with the percentage change is for us to see the trend. Whenever we see these high green bars, it is generally during the periods of high activity as well. So it sort of goes hand in hand. And it's not necessarily true that one drives the other. Both of these are driven by the strength in the ag sector, by the strength in the ag markets in general. When the ag sector is doing great, it supports incomes, it leads up to land values. That's also a period when a lot of people are interested in buying farmland because it seems to be doing so great. And a lot of that is driven by sales, in my opinion, because in times like these, not as many people will be selling, not as many people will be buying. So we just don't have enough activity on the market. But yeah, so now in 2025, there was still less activity reported than last year. It plummeted in 2024, but it's still sort of going in a better direction. Markets are slowing, but let's see how long they remain slow, how long we remain in this sort of a slump. But generally, whenever we have been in this slump are the periods when we saw reds in the market, when we saw this. And it's sort of matching that same trend. The green bar right here at the end is quite small, but it's going in that direction. Let's see what 2026 brings. Now, I mentioned this already, but here are those stats again. 84% of farmland in Iowa is owned debt-free. And then the second thing I'd like to combine it with is the second information right here. 66% of Iowa farmland, that is 2/3 of all Iowa farmland, is owned by late-stage farmers. These are farmers that are 65 years of age or older. So they own most of Iowa farmland. And the reason that highlighting the late-stage farmers is important is because that's the time by when your farm business is as stable as it's going to get. You are no longer a beginning farmer. Most of the debt is going to be off. So this is also the time period where you have probably seen a couple of peaks, a couple of downturns, and you know the period of accumulating good cash reserves. So this forms the bulk of our landowners. They know when to buy. They know the land will always be back up again, and they also have gained the wisdom of holding on to those cash reserves when the opportunity presents. Which is why, even though farmland values fell, we did not really see drops in the land market. We did not see drastic declines. Our farmland ownership is very stable. It is not really, there's not the leverage we saw in the farm crisis. That was a lender sort of driven crisis. And the current situation, our values can go up, our values can go down based on the income influence from the farmland, from the ag sector. But as long as these statistics remain within this neighborhood, we're not really going to see a repeat of the farm crisis. So values can go up and down based on the current income a little bit, but we wouldn't see those drastic movements. The prereq for that is land very much being or farmers being very much dependent on debt. Now, what were some of the negative factors that kept the values from being higher? First of all, commodity prices being lower. We've talked about that already. We'll look at some graphs, but essentially that's the biggest negative influence on farmland markets this year. Then the interest rates, even though we have had a few cuts at the end of 2025, we are still in a period of high interest rates. Then input costs, we'll talk about that as well. On one hand, commodity prices are getting lower. On the second hand, input costs remain elevated. Not a great combination for profitability. Then there's some uncertainty in the macroeconomic situation, which generally takes away the buyer confidence in any sort of market, and farmland is no different. Then the cash and credit availability. Now, there are always going to be people who are going to need to borrow to buy farmland, especially when there's a pressure on the working capital, especially when we want to, on one hand, promote beginning farmers to buy farmland. The current credit environment doesn't really make it great for those wanting to start, or those who are in the first few years or the early stages of their establishing their farm business. Then yields did take somewhat of a hit, and that's been reported by a few respondents as well. Now, looking at the prices, the two things I'd like to highlight is, first, again, compared to the pre-pandemic levels, our prices are better. If we are looking at the last decade or so, individually, our corn prices, our crop prices are not terrible. It's the combination of those prices with the production cost that makes it bad. So I don't necessarily want to say that we have very low commodity prices, because 410 is not bad. We saw the peaks and we were spoiled, but it's not a bad price. But it's the pressure from the cost that really keeps us worried. Similar situation in the soybeans markets. The January WASDE estimates decreased 30 cents from the December estimate and ended at 10.20, still lower than the cost of production per bushel as per the ISU cost of production survey. Now, interest rates. Interest rates were cut a few times at the end of 2025, and we are not at 5% where we were when the hikes after the pandemic were made to combat very high inflation. We are coming down from those hikes. But each of these years began with expectations of these hikes being much faster. We're not coming down as quickly. And the reason is that, let's get here. And the reason is that currently there's two different directions that are being discussed, that are the two major influences or two major factors when deciding what to do with interest rates. On one hand, there is inflation, which is still high. It has come down. It has not come down to the target rate of 3%. uh, are the FOMC committee, the people who decide the interest rates. So there's a whole bunch of them. These 9 people, there's almost half of them who really want to focus on inflation. But then there's also a few of them that want to keep an eye on the labor market. Our unemployment rates are not doing great either. They are also rising. So generally, when inflation is rising, we would want higher interest rates to slow the economy down, bring the inflation level down. But when unemployment is rising, we would want to decrease interest rates to stimulate the economic activity and then bring employment levels up. Now, these two mandates currently are going against each other. We have inflation that is relatively high, prices are high, and then the unemployment is also rising. So that's why there are people who would want interest rates to come down. There are people who would want it to go up. As we're entering 2026, we don't necessarily know with clarity what will happen this year. There might be a few more cuts. There might be more focus on unemployment mandate, but it's also possible that the inflation mandate takes precedence and then we have rising interest rates. We want to keep an eye on it because if interest rates are rising, remember that very first equation we saw, interest rates were in the denominator. If that denominator increases, it puts downward pressure on farmland values. If that denominator declines, that's when land values go up. And then any changes in interest rate, they take about a decade to be capitalized fully in the land markets. We are still feeling the pull or the downward pressure from the high interest rates of 2022 and 2023. We will keep feeling them until the next few years as well, unless we see dramatic slashes that balances that effect. And we are not seeing that dramatic slash. So we are still in a period of high interest rates and we're still feeling the pressure from previous increases. And those two factors make interest rates a major negative factor even in farmland markets right now, despite the fact that we didn't really see a lot of movement in interest rate itself this last year.
Dr. Rabil, on that question, on that point that you just made there, even if the interest rates rose fairly quickly, which they did in those 2 years, you're saying even if it was for a short period of time that they were higher, that we're going to be reeling from that, or we're still reeling from it right now, but you're saying that's going to continue on for many years to come. Even with rates coming back down, or even if they went back down to what they were for almost a decade, which were almost zero.
Yes, and my short answer is yes, we will still keep feeling the pressure from that. But then to elaborate on that, I will come back to this graph. We went from virtually zero to higher than 5% in a year, in less than a year, in about a year actually. So in around this time, this was a very short period for a very high increase in interest rates. So that is what amplifies the pressure all the more. And although then it remained stable. All the time that it remained stable, it means we are still in the period of the high interest rate. Went down a little bit, still remained. We are still higher than 3%, higher than 3.5%. And when we think about the agricultural interest rate, the interest rate for ag real estate, it's a few percentage points higher than the federal funds target rate. For us, it's not 3.5%. The rate that we are getting is around 6-7%, in some cases maybe 8%. So for this 3.5% seems to be a reasonable number, is not what we are experiencing. So that is this. It's not just the lack of decline; it's also remaining at the higher amount or the higher number for 2 years at this point. That is building the pressure. So from the mid of 22, I think these hikes began in July, if I remember correctly, July of 2022. So from this July all the way till probably the end of 2025, even here, I would say till here we were in a period of high interest rates. So we have 2.5 years of high interest rate pressure. To get out of that, this is what we need. We need a slash, but that is not happening. Our economic conditions do not indicate a slash like this coming up or a slash like this coming up. This was in response to the 2008 economic housing market crisis. This was in response to the pandemic. And hopefully, we won't see a situation like either of those. So, unless something drastic occurs, we are not going to see that slash. So, we have at this point 2 years of pressure, which is countered by a few months of slightly low interest rates. It's if we're just looking at the weights on either side of this bar, the negative pressure is still a lot higher than the positive one. That needs to go up or by decreasing the rates a lot more. And otherwise, we will still keep feeling it.
I just think that's an important point to highlight, just because that's, we think of that in maybe year to year terms, but from what you're telling us, that's something that we're going to be having to deal with for quite a number of years.
Yes, and the other thing I mentioned was that it takes about a decade for the interest rate effects to
Right.
be fully capitalized. That's also it's like so the changes that were made in 2020, 21, we are still feeling that. A lot of people, why are we feeling that? Because if you think about it, people did benefit from those low interest rates, and that benefit did lead to a lot of higher income accumulation, capital accumulation, which is still affecting the market. So whatever those interest rates touched, it's not completely evaporated. So the effects of those interest rates are still being passed down. And whatever these high interest rates are touching is still affecting us. This is still very, very recent, very, very new for us. It's not really that long ago that people don't really care about what the interest rate was last year. Now, if we think about where the farmland markets will go, we ask our respondents about their short-term and long-term predictions for farmland markets. Within 1 year, at the end of 2026, most respondents expect minor changes, more stability. The highest category, this blue bar over here, is 28%. 28% of the respondents reported that farmland values will likely remain the same next year. And then the second and third categories are a decline of less than 5% or an increase of less than 5%. So overall, we expect markets to be within -5 to +5%, which to me, I will highlight again, is stability in the land markets. If values are moving less than 5% in either direction, it will highlight a situation like the one we have pretty much this year. There's an overall increase, it's a small increase, but whenever there's an overall small increase or an overall small decline, that highlights there's likely some differences based on region. Some regions are feeling one thing or the other, and there's no one clear picture on what everybody is feeling. So we're probably going to be in this similar situation next year as well. Over a long enough period, farmland always gets back up, which is why we like it as an investment. So that's what our respondents also note. By 2030, the highest reported category is an increase of 10 to 20% in farmland values. Then there's an increase of 5 to 10% reported by 23% of respondents. Then there's an increase of more than 20%. So some people are very optimistic.
Very bullish
There's a
on that one.
few. Uh, what
But
did
I
you
just
say?
said
Sorry.
very bullish those people on the 20% increase.
Yes, yeah. So, so yeah, over the long run, we'll probably be fine. Farmland always gets back up. Then, if we compare it to the projections or the predictions that come out of the survey from Purdue Center for Commercial Ag, uh, they expect farmland values to increase. So here it's the percent of people who expect higher farmland values, these are in green bars, and then percent of people who expect values to be lower, red line right here. If the green is higher than the red, it means overall the market expects an increase. And they have been that way throughout. They have been that way for the last 5 or so years. This was the period when we were experiencing pandemic peaks. Most people expected increases, and this has been since the peak. So that is this expectation is not independent of the ag sector. I don't have that slide here right now. Let me just make sure. Yeah, I don't. Let me But when they also have a question that they ask their respondents about what are the major reasons, influences in their farmland markets that they expect. And for them, the highest influence people reported was from investor activity. And my expectation is that it's likely that investor presence, which is making them be on the hopeful side about farmland markets despite the struggles in the ag sector. And we talked about that investor presence early on as well, and that introduces some degree of stability in Indiana farmland markets. Now, when we look at who the buyers of Iowa farmland are, the highest category has consistently been existing farmers. It still is that 68% of all reported transactions are by our respondents are have gone to existing farmers. There's a quarter of all transactions that are attributed to investors. But when we say investors for Iowa, I would like to highlight. For us, it's not TIAA. For us, it's not Microsoft buying farmland. Those institutional investors cannot operate in Iowa. For us, the investors often mean an out-of-state person, somebody who is a farmer in Kansas, they're buying ground in Iowa. Maybe they will rent it out, maybe they won't. Somebody who is once or twice removed for farming, let's say, and their grandparents were maybe farmers, and now they have inherited some money. They choose to invest in farmland, but they're not the ones farming it. For us, the investor profile often looks like those individuals who either have some connection to farming now or had some connection to farming before. In very few cases, it's going to be other people who have no connection to farming or ag at all, and then they're investing in farmland. In all the cases, it's still going to be individual buyers, individual investors, because we don't have corporate investors present. Now, one phenomena that's sort of changing over time a little bit, and it's related to the investors in Iowa, so I want to highlight this here as well, is there's one question that was added to the Iowa Farmland Ownership and Tenure Survey, a survey that we do every 5 years. It was added in 2012, and since then we have been measuring people's or asking about people's primary reason for owning farmland. So all the owners in Iowa, why do they own farmland? And in 2012, the primary reason was to support the landowner's current income. 56% of farmland was owned to support the owner's current income. And the other categories that were asked about were whether people are owning it for long-term investment, family or sentimental reasons, to make their home there, or for recreation purposes. And since then, till a decade later in 2022, which is the most recent data we have, it has flipped. Now it's the biggest reason is almost a tie between owning farmland to support current income or owning for family or sentimental reasons. This statistic I want to highlight to allude to sort of the intergenerational transfer that's happening. We hear about it a lot. We hear about it being ongoing since 2 decades. It's still ongoing. It's happening gradually. It's not like there will be one day where we'll see a cutoff and the land is transferred. But this is an indicator of that transfer sort of changing the motivations for the next generation's ownership of farmland. A lot of people as as a as a, excuse me, I'm getting a call. Let me just silence this. Yeah, a lot of people owned farmland in the idea we have or of a farmer 2 decades, 3 decades, or at least 5 decades before, like my parents' generation, my grandparents' generation, was to support your current income. You never farmed for any other reason. You did it because that was the primary occupation you had. It has changed now, so much so that a similar amount of farmland is owned to support current income as is owned for family or sentimental reasons. That's when your kids or your grandkids, they have probably gone on to different careers, but the land they have inherited, they are likely maybe not selling it, but their job is in the city, they're not coming back to the farm, but the ownership motivation is no longer to support the current income, that's something else. This will likely lead to some sales, likely lead to some transfer. This is also a likely contributor to a lot of leasing activity that has increased. 56% of Iowa farmland is leased, and 65% of Iowa farmland is leased in as of 2022 as well. So it's likely coming from people owning farmland, keeping it because it was in their family, but not necessarily having the time or capacity to operate it directly. So that's a change we're experiencing. I'm curious to see how this trend changes in 2027 version of this survey that will take place in a few years. Now we talked about corporate owners. One other category we think of is foreign ownership when we're thinking about big corporations or, let's say, non-Iowans or external folks owning farmland. So this is a map of acres that were under foreign interest in the US in 2023. And I have designed it to be misleading. Let me begin with that. There's a lot of blue
Nice.
it's terrible. It seems like all of the US is under foreign interest, and we have so many acres. But what I want to highlight here is that let's look at the key for the heat map. So the darkest category is when more than 100,000 acres are owned or have some foreign interest. The interest could be ownership or lease. It could be either of the two. But most of the counties here are not in the darkest category. They're in the middle blue, which is often 2,500 acres, 5,000 acres, in some cases 10,000 acres. So now when we map the acres as a percentage of total county area, it's the same information. Now almost all of the blue vanishes. So if we are not looking at the number of acres, but we're looking at the percent of county area under foreign interest, we see it is not as drastic as it looks at first sight or at the first impression it gives. There are a few counties that are still a little darker over here. That's and then some lake counties over here. That's because the county land area is generally less. There's in at least in these corner cases over here and over here, it's where the total area of these counties includes a lot of water base as well, and which is not included in the total land area when we're computing this number. Other than that, most of the country, we don't really see a big percentage of foreign interest. Again, the interest here is both ownership and leased. Now let's narrow down further and look at some numbers for Iowa. I did this analysis, and this article is available at the Ag Decision Maker as well. For the top 10 Iowa counties with some foreign interest, according to the latest FIDA data, the 2023 data. These are the top 10 counties right here, Pavashik being the top. The total foreign interest acres around 45,000. First, when we break it down by owned and leased, almost all of that is leased. That's not only true for Pavashik, that's true for almost all of the top 10. There's a few acres that are owned right here, but for everybody else, we see all of that interest comes from leased. Now, I won't talk about this last column just yet. Let me break down the other things. Then, where does this interest come from? Crop, pasture, forest, other ag, other non-ag. Almost all of that in a lot of cases is crop, except for Webster County right here, where the majority interest comes from pasture. Now, other than so these ownership acres, owned or leased, as well as the land use is reported in the FIDA data directly. Total acres, ownership acres, land use. Now, this is a variable I constructed myself, whether the acres are used for energy use or not. And how did I construct those? By looking at the names of the owners. FIDA data, the USDA publicly available FIDA data makes the owner names available. And if the company is called XYZ Wind Farms, XYZ Energy Farms, and it's quite reasonable to assume that it's probably a wind farm, not really something else that's happening on this land. And when we make that cut, we see that almost all of the interest which was mostly leased, is used for energy purposes. And for Iowa, it's mostly wind energy. And the top country of interest is also mentioned here in a lot of cases. I will just say these are not really the countries we are concerned about. So this is the foreign ownership is not really a danger for Iowa or the Midwest or the US in most senses. For the US, the biggest foreign owner of US land is Canada. So and that's a lot of timber interest, which is not something we are concerned about per se. Now, if we map the trend of how this total interest has changed, the top of the bars show the total acres that have some foreign interest, again owned plus leased, and then the light middle blue bars right here are the proportion of that is explained by energy use. So we have had an increase in foreign interest acres, that is true, but that increase mostly comprises of or comes from the increase in wind energy use. And wind turbines, that's also pretty explainable when you're driving across Iowa. You have seen them increase over the last decade, much more so than the previous decade. It's between 2015 to 2025 when we have really seen the number of wind turbines increase a lot. In fact, for Iowa, most of the increase begins in 2018. And that's what explains a lot of the foreign interest as well. Now, this information is available at the AFIDA tool, the foreign interest tool on our farmland portal that I mentioned before. You are able to toggle between the years to see how this map changes over time. You can see the information in terms of the total acres or as a percentage. You can see any type of use you want, either wind energy, solar energy, all energy, or you can see it by the crop, pasture, forest, or what type of land use it is. Restrict to owned land or leased land, or look at the entire data. So you have this mapping tool, and then right underneath, you can take a picture of the map you make up as well to see this is the information. Then right underneath, you also have, once you click on any county, any year, whatever information you've selected, you will see what the in the owner's information for your selection is. And now this is Power Sheet 2023. Again, the top foreign owner of Iowa Farmland County. If you look at specific owners, the interest comes from English Farms Wind Project, North English Wind Project, country Italy. Now this data is coming from this is coming from the USDA official data. And I've also computed the percentage change right here. So this 12% of Power Sheet is mostly coming from wind energy projects. Now, since for wind energy, it's not a substitution from ag, you put the turbines on the farmland, it seems to be that the entire farmland is counted. And so when you're thinking about the actual foreign interest, it's that 1 acre on, let's say, an 80-acre field or something of the sort. Now you can again find this and a lot more at our farmland portal. If you have any specific questions, I'll put up my contact information on the slides here as well. With that, I'll end the presentation. I have a few other sets of information at the end if you want to, if you get to those questions, but now I'll give Josh a chance to ask questions.
Dr. Rabel, thank you so much for that. There's so much that you unpack in a relatively short amount of time. Honestly, it's incredible. Actually, if you get a chance to pull your slides back up there, I'd like you to go to the slide you had there that showed all the different percentages. It might be a little bit of a ways back of all the different counties and their changes. And I, of course, noticed my home county up here in Kossuth was the leader, or maybe that's not the right way to put it. It was that had the highest decrease in land values of any county in Iowa.
Let's see. Going here. This slide, you mean?
There you go. Yep. You see Kossuth County negative 4.3. That was the biggest decrease in land values. Now you see that whole north central portion, and I
Yeah.
think you may have pointed this out when you were doing your presentation, that that's essentially from our lack of cattle in that area of the state. Is that accurate?
Pretty much so. Rather than saying that it's a lack of cattle, one more thing I will say is that if we look at where the Des Moines lobe is, like
Yep.
right here, it's the
Yep.
most fertile part of the state. So it's the lack of cattle also makes sense. That's the best farm ground. It is utilized as such by very smart farmers and landowners, but that also leads to years like this. So yes, it's due to the best possible use of the farm,
We
which generally
appreciate being called
benefits in all
smart
other
as well.
years.
We appreciate being called smart. Most of our drainage tile, of course, is put in right in that, the Des Moines lobe as well for that very reason.
Mm. So yeah, so that's what really like explains it. But yeah, it is a lack of cattle, but the lack of cattle is only detrimental this year. Generally, it's not really a problematic situation.
Yeah, generally, you don't see that, but as everybody can see on screen, that definitely is the weakest part of the state without question.
Yeah, but then it's also both of the every sector, whether it's crop, whether it's animal, whether it's agriculture as a whole, or even if we consider tech, it goes through ups and downs. It goes through peaks and then it also goes through downturns. So the diversification helps keep the income stable. But one other phenomena that comes with diversification is, let's say you have a 50% animal and a 50% crop operation, is that you will probably be at net zero. The highs from that will be balanced down, the lows from this will be balanced up. So you want like that stability of the income is gotten by it, but over a 10-year period, you're also going to benefit from the highs as well, get a loss from the lows. So if you can sort of balance across time by maintaining cash reserves from the highest period, you sort of do that yourself. Then you don't necessarily need the animal sector to do that for you. Since most people, like human beings in general, we are not great at it. We like to spend money when we have it. So diversification turns out to be a great business strategy. But theoretically, anybody can do it individually as well by sort of managing across time.
Were there any data points that you came across as you did this that were surprising to you, or that would, benefit all of us that are, that would buy and sell farmland and farm?
Um, One thing that we didn't talk about explicitly, but I would like to highlight is was on let's go. Let's think about the activity in the farmland market. So we are reporting, or I always measure, and it's not true for me, it's true for all the surveys that are done. They will report the change in land values based on the activity this year. The activity this year was very low compared to the last year, the year before. It's very low. And that lower amount of activity or amount of transactions is what's representing the increase or decrease in land values. And generally, it's a loss is not realized until you have sold something. A gain is not realized until you have sold something. So we talk about farmland values going up and going down, but for those, like for the people whose wealth is defined by farmland, it's not necessarily a bad situation just because farmland values are struggling or they have more of a downward pressure than up in these recent years, because it will come back up. So any losses are not really realized when it comes to farmland markets. The ag sector, you have an annual profit and annual loss, crop markets, livestock markets. For farmland, you don't have an annual profit and an annual loss. It doesn't even work that way in terms of stocks where you're getting a dividend or something. And that I think I want to take away some of the pessimism from the market by highlighting that we are in a slow period, but that's the limited amount of sales that are happening right now that represent that. And if it's not even a matter of if, it's when the market picks back up again, it'll go back up again. And then the wealth numbers will be back up again. And one more thing that I'd like to highlight that's not in this set of slides is there was some other work that I did talking to different people in Iowa, appraisers, farm managers, farmland owners, to talk about how they, in their perspective, land as an investment has changed over time. And one thing that surprised me, at least that was not my prior belief, is that more and more of the income or the return on investment from land is coming from appreciation now than it was before. So the cash rent as a percentage of land value, which we like to call the cap rate, has been shrinking quite consistently. And it's my expectation was, or my naive belief was, that it'll likely go back up again. The cap rate will increase back up again. There will be some sort of an adjustment the way value has adjustment periods. But that has become the new norm, and people who are active in the land markets are at the same page with that information. They are expecting the return on investment to come from appreciation, not from cash rents. So if some of these sentimental investors we're thinking of, or the next generation who's inheriting farmland we're thinking of, these people, they are not really relying on the current income. So we will never see cash rents be a high percentage of values the same way again. So that is one shift that has occurred slowly, but over the last 10 to 15 years, that's a shift that has occurred in the land markets, and that and like it was a matter of the information being pointed out because the data has been showing that, but it is for good, and that change I think has happened now. So that was surprising to me to think about and to put my head around, but that's another information I'd like to share.
Interesting. I appreciate that big time. You and I could talk for a lot longer. I guess the last thing I'll ask, you have your crystal ball of 2026 highlight, what's going to be where you and I are sitting here a year from now and talking about the land market of 2026. What are your thoughts? What are we going to,
So
with an exception of a black swan, of course, but just, you're such an expert in this. I'm just curious.
my expectation, in fact, my hope is that land values remain stable. They remain lower. I don't want to see a dramatic increase. And I in as 2026 is starting, we are expecting very high government payments again. But to me, that like I would like the growth in the land markets to come from stronger cash receipts, stronger crop incomes, stronger profits, not from ad hoc payments that we need because we are not in a great situation. But they do go into the income equation, so they will maybe increase it a little bit. But my hope is that we reflect the income more closely and we probably stay at a stable rate. My personal prediction is another small increase, 1 to 2%, or a small decline, 1 to 2%, maybe more on the increase side. That's where I expect markets to land. Because I expect livestock to keep doing better, and crops will pick back up, but it's 1 year is a very short term for things to go back to great.
You heard it here first, everybody. Dr. Rabel, thank you so very much. I so enjoyed our conversations here. You're so kind to be able to do this. And everybody, this is Josh Mansky signing off with the Corn Belt Newsletter Podcast, and we will see you next time.
Thank you. Thank you for having me.
Yes, thank you, Dr. Rabel.